Hi, my name is Yasha and I help young men invest in the stock market. So today we are going to analyze this extremely famous company called Netflix Incorporated with the stock ticker NFLX. As you know, this is probably one of the famous companies in the world. You watch Netflix every single day. So let's take a look at it together, okay? As always, we are going to analyze it using this little Canva presentation that I have right now here. And yeah, just follow along, make some notes, you will learn a lot, okay? Now, first of all, why should you even listen to me? As you know, my name is Yasha and I help young men invest in the stock market. Click the first link in the description and I will teach you everything about it when you have more trust for me, okay? Now let's begin with the actual analysis. This is going to be very simple, beginner friendly, straightforward. You will learn a lot because obviously you want to learn something about stock market analysis. It's that simple, okay? So grab a piece of paper, make some notes and let's go, okay? Whenever you analyze stocks as a complete beginner, you should generally care about the following six things. You should care about chart, profit, debt, money at the bank account, value and price. Now here are some quick facts about Netflix. It's a company that works in entertainment world, they are making films, shows and so on and so on. It was founded in 1997 and it's very famous and you also watch it probably every single day. Now here it's immediately the first thing that you should pay attention to. You should pay attention to when the companies are established, okay? Because generally it's better to invest in companies that are a bit older, for example, since 1950, 1960, 1940 even, you know what I mean? Because the older the company is, the higher chances it has to survive any potential crisis that might happen in the future, okay? For example, if we take a look at Coca-Cola, which is already 200 years old, for example, they survived they survived the Great Depression, they survived the Black Friday, they survived dot-com bubble, they survived, I don't know, 2008 real estate crash, they survived coronavirus. You know what I mean? That's minimum five major events where the stock market crashed, okay? And the Coca-Cola is still right now here today. So when you compare Coca-Cola, which is an older company, or any old company, with Netflix, which was founded maybe how many 30 years ago, you have with Netflix much higher risk that Netflix might potentially not survive any future crisis that might happen because it's a younger company and okay, obviously Netflix is a bit exception because they are very famous, okay? But if you would have some startup that works in IT or maybe some startup that is, I don't know, a garage or something, it's much higher risk that they will not survive. You know what I mean? So as a rule of thumb, the older the company is, the better it is as an investment because you are more sure that they will survive any potential unexpected event, okay? I talked way too much now, but that's the rule of thumb, okay? The older it is, the better. Now let's go further. Now we will analyze the chart, okay? And for chart, we have an instruction that it has to grow for all 10 years. Now, what exactly does that mean? That means that I will draw a little exponential line, kinda like that. And now we are going to compare the stock price chart, which is this orange line, with that black growing line, okay? And preferably they should follow each other because we want to invest in companies that are growing, that are expanding, that are profitable. And how can you know that? If the stock price goes up, that means the company is good, okay? Otherwise it wouldn't grow. It's that simple. Now let's compare it. Does the chart follow this black line? Yes, it does. Let's say until 2022, more or less. And then it fell massively and then it grew massively again, okay? So chart here is actually not that great because of that massive gap here in between. But still the company, probably here it was some Ukrainian war or some other issue, that's why it fell massively. But then it went up again. So I think the chart is still good to go here, okay? Because it went down massively, they probably fixed that issue that they had, and then bam, upwards again, okay? So this is good. Now let's come to the profit, and for profit we have again an instruction that profit has to be in plus and it has to grow as well. Now here is the very same story as with the chart. We will draw a little exponential growing line, kinda like that. And we are going to compare the profit chart with this line, and preferably, again, they should follow each other, okay? Because we want to see companies that have increased profits through the years, because that means that the company is profitable, it's growing, it's expanding, it's a nice opportunity to invest, you know the drill, okay? Now here obviously the profit is growing through all of the years, which means that the chart is very good. But don't be confused here with 2022, they had a little gap, like the profit was not as high as 1 year before that, but still then the next year they managed to even increase the profit, so that's good, okay? Obviously, the chart will always go up and down, up and down, up and down, but as long as it has that momentum towards the like right end, towards the here, you know, it's good thing, okay? The profit has to grow, of course, with ups and downs, okay? So the profit is also good to go here. Now we come to the debt, and for debt we have an instruction that debt has to be low and preferably it should also decrease through the years. Now here we have exactly the opposite. Here we have the growing debt. As you can see, the debt goes up, but in the recent years it's falling a bit, so that's a bit good sign, but not good enough, because the debt in the previous years before that increased massively and we don't want to see that, okay? So debt is growing, it's high, and we don't want to see that at all, okay? Now we come to the money, and with the money that we measure here, we actually measure the money that they have literally on their bank account, okay? For example, you are a young man, you probably have around 200, 300 euros on your bank account. Here we measure the exactly same money, okay? And preferably, they should have more money than the costs. Now, how do we know that? We take a look at the money in the bank account, okay? You are a smart young man, use your brain. Look, they have plus $7 billion on their bank account, which clearly means that they have more money than the costs. Now, why is that important? This is important because whenever something unexpected happens, they have the money to cover that unexpected event, okay? For example, let's say that tomorrow their studio where they film Too Hot to Handle 6 or something, let's say that that studio breaks down, that the camera is destroyed, that the film got deleted or something, then they have that much money to somehow cover that expense. You know what I mean? Generally, also with you, the more money you have on bank account, the calmer you are, the better you sleep, more relaxed you are, you know. Same is with the companies. The more money they have, the better they are, you know. The calmer they are, the management is not doing some crazy decisions, you know. They are not taking additional risk that they don't need. You know what I mean? So the more money they have, the better. So here they have $7 billion, which is more. They have more money than the costs, which is a good sign. So we are good to go here, okay? And now we come to the valuation. And obviously, whenever we invest in stocks, we want to invest in undervalued stocks. Now we measure valuation by two things. First thing is called P/E ratio, as you can see right now here. And the second one is called intrinsic value, okay? Now, as a rule of thumb, P/E ratio should always be lower than 15, and intrinsic value should always be higher than the current stock price. As a complete beginner, those two things might sound a bit complicated, and I will explain to you right now what this means. It's very simple, okay? P/E ratio is used to compare Netflix with the overall stock market and with overall competitors of Netflix, okay? Generally, bro, the stock market P/E ratio is 15, okay? This is the average of all of the stocks on the stock market, okay? It's 15, and we want to invest in stocks that are below that are undervalued, okay? Because they have higher potential for growth. Now, P/E ratio of Netflix is 45, which is around 3 times higher than it should have been. So in terms of the P/E ratio, the company, so let's say Netflix, is overvalued, okay? it's higher than the market, so we don't want to invest in that, okay? Now let's come to the intrinsic value. And intrinsic value actually tells you the price that the Netflix should have at this exact moment, okay? So let's take a look at the example. Based on this, intrinsic value is $360, okay? So this is basically the price that Netflix should have at this exact moment, okay? One stock should cost 360, but in reality, the actual stock costs $656, okay, which is around 300 higher than it should have been. You know what I mean? So intrinsic value is a calculation that tells us what the price should be, but the current price is the actual price, okay? And in order for stock to be undervalued, the intrinsic value should be higher than the current price. That's quite logical, right? The higher it should have been, the more it's undervalued. You know what I mean? So in our case, we have intrinsic value which is lower than the current price, which means that the stock is overvalued. It's overvalued as well, okay? So the stock is overall overvalued. You can find both of those numbers on the internet. Just write Netflix P/E ratio and you find it, Netflix intrinsic value, and you find that data as well, okay? Now we come to the price, and the stock price should be lower than 150 euros, or for you, you are from America, for you, dollars, okay? Now the current stock price is actually much higher. It's $650, more or less, which is way higher than 150, okay? So the stock, according to us, is overpriced. Now, I decided 150 euros as a limit until which I would invest in one particular stock, because whenever you are a young man, you are tight on budget, okay? You have maybe 500, 600 euros, and then if you spend all of that money on just one Netflix stock, you do not diversify your portfolio, okay? You are having much higher risk, okay? So try to find stocks that are below 150 euros, invest in them, and then you can buy more stocks and more different stocks, from different companies, and you have more diversified portfolio, which is overall better for your own stock market growth, okay? So whatever is below 150, it's a good buy. This is above, this is maybe 4 times, 5 times higher, so we are not interested in that at all, okay? Now let's come to the final evaluation. Here we are just going to summarize everything that we found out about the company and then decide whether we should buy it or not, okay? Now, does the chart grow? Yes, it does. If you don't believe me, go a few minutes back and watch the video again, okay? Does the profit grow? Yes, it does, as you know that. Does the debt decrease? No, it doesn't. It actually increases every single year except for the last few years. Do they have money on the bank account? Yes, they do. They have $7 billion. Is the Netflix under or overvalued? It's overvalued because P/E ratio is 3 times higher than it should have been, and the intrinsic value is for $300 lower than the current stock price, okay? And also the price, is the stock below 150 euros? No, it's not. It's around 650, which is way too expensive for us, okay? Now, should you buy or sell? In my opinion, you should sell Netflix because they are way too expensive. They are profitable, but they are expensive. They are overpriced. They are already, I think you missed the train with Netflix, honestly. You should invest in Netflix when it was starting to get developed, or at least when it was that coronavirus, when everyone was at home, when everyone was watching Netflix. You should invest in that time. I think right now you are too late. The company is too expensive. It is true that they are growing, but still they are just expensive. In my opinion, the 650 for one stock is way too much, and I wouldn't buy it, honestly. It is profitable, that's true. It has nice financials, but in my opinion, it's way too expensive. It's way too expensive, and we are on tight budgets. We are hustlers. So in my opinion, we should avoid this stock. Obviously, if you think that this is interesting, go for it. It's an amazing company. If it would be cheaper, I would buy it as well. If the stock would be around $120 or 100 even, I would go for it. No problem whatsoever. But right now it's way too expensive. It's overpriced. It's overvalued. So I don't think that I am interested in that whatsoever. Okay. Now, if you want to know more about stock market investing, click the first link in the description. Join me also on my journey to become millionaire with stocks. Click subscribe. Do the hard work, brother, and see you on top of the world.